Good evening. It's Wednesday. It's another Wednesday. It's almost halfway through May. Man, the time is flying. It's the Alberta Landlord Shoptalk show. I'm your host, Mackenzie Wilson. Chris Noble is away where he's dealing with some tech issues. I think I'll have to get in the drive down to Calgary and fix his computer for him. He's having some trouble right now. But nonetheless, we've got a really cool show lined up. This is kind of another part with what we had last week. We had Shaune on last week, which we talked about mortgages, qualifications, and some numbers behind that game. This is going to be a really interesting conversation tonight about different strategies. If I'm going to put this in the right words, I'm sure I'll get corrected when I get these gentlemen on the air. But we're moving debt around in such a way where you're not spending any additional money or taking on any additional debt, but you're basically moving debt where it's not qualified to write off. It's not tax deductible, and making it tax deductible by simply doing the strategy that we're about to discuss tonight. So if you've got a primary residence, which I imagine all of us do, plus you've got some rentals, there might be some different ways to affect your tax write-off and some positioning for tax purposes with this strategy. So pretty excited about it. Shaune will be on as well with us, help clarify any of the mortgage related questions. I'm actually in the process of getting this set up, so I'll use myself as an example and we can kind of learn along and figure this out. Folks, as always, a little bit of housekeeping right now. We are best viewed on YouTube, so check us out there at findgreattenantswithan.com. As well, we have I'm going to give a bit of a heads up. We've gotten a little bit better at booking some of our shows in advance. We've got some good content coming up next week. We've got our favorite show. Trish will definitely have to be here for that one, but we've got, you know what, let me show this. Let me do this for you guys. Does that work? There we go. Here's our calendar over on albertalandlordcommunity.ca. We've got one of our coolest conversations that we're going to have in a while here is we've got a law enforcement agency coming on the show. They're called SCAN. They're with Alberta Sheriff's Department. They stand for Safer Communities and Neighborhoods. They're specifically a law enforcement unit that tackles problem properties. So I think this is a great conversation as we're definitely being landlords. We're a stakeholder in this problem where if there's problems with your properties, you need to engage law enforcement. Perhaps you have illegal activity. I mean, this doesn't only relate to your landlord and your rental properties. This could be in any property in your neighborhood if you're seeing suspicious activity going on. So they're going to talk about how SCAN works. We're going to have one of the sheriffs on the show. And we've seen this conversation pop up a few times in the community already where people have actually engaged with them. They've had the ability to go in and shut down problem homes. So if you've got maybe a drug house or there's other illegal activity on, these guys have the illegal, called the legal right. They have the law, the enforcement capability to shut down a house and evict those tenants out on the spot, depending on how severe the problem is. So a really interesting conversation. That's next Wednesday at 7 p.m. So guys, definitely come check it out. Be pretty exciting. So without further ado, I'm going to take this off. Let's get these two gentlemen on the air. We've got Robinson Smith with the Smith Manoeuvre. That's the strategy we're talking about tonight. And we've got Shaune with Mortgage Line. Gentlemen, how are you guys doing tonight?
Hi, Mackenzie. Doing well, thank you.
Perfect.
Very well, thank you.
Excellent. Cool. So I'm trying to paint this picture, but really excited about this conversation. Now you're going to give the kind of a run by Robinson, but we'll go through. It's basically, we're not, if I'm going to do my elevator pitch and you correct me on this, you're taking debt that we already have with most of us, which is a mortgage. You need a certain product, which is this Readvanceable Mortgage or a mortgage with the HELOC. And you're taking that debt, pulling it somewhere else where now you've got interest deductible or tax deductible interest by repositioning it in your portfolio.
Yeah, the problem that we Canadian homeowners face is that when we take on what's likely to be our biggest liability, it's 100% non-deductible debt, our mortgage. Because we are borrowing from the bank to buy our house, the government considers that to be borrowing to consume because we don't have any reasonable expectation of generating income from that asset. However, if we borrow with the reasonable expectation of generating income, we can deduct the interest. And so that involves borrowing to invest in stocks, bonds, mutual funds, ETFs, real estate, all these types of things where you can reasonably expect income, you can deduct the interest. Well, our American cousins, they can deduct a good portion of their principal residence mortgage, right? So they're at a bit of an advantage compared to us Canadian homeowners. That being said, they don't get the capital gains exemption when they sell their house, and we do. But the Smith Maneuver is a way that we can not only retain this capital gains exemption when we sell our principal residence, but also deduct the interest on the mortgage that we have on our principal residence.
That's very cool. Okay, that's an interesting play. And how did you come across this strategy? Like, where did it come from? Give us a little bit of history on it.
Yeah. My dad, Fraser, was a financial planner back in the early 80s. And around that time, he was interested in this fact that we cannot deduct the interest on our mortgages, and the Americans can. And so he decided he was going to level the playing field here and figure out a way that we could do so. So he came up with the strategy, called it the Smith Manoeuvre. I wish he called it something else, because even I don't spell maneuver correctly every once in a while. It's a tough one.
Yeah, fair enough.
Yeah. So in the presentation I talk a little bit about the history, but yeah, it was my father that pioneered the strategy. There's a lot of different tools and techniques out there, and it was a matter of pulling some of them together and creating some new aspects to come up with the strategy.
Cool. Awesome. And your dad's gone as so far as to have a book out on it. So you have a whole published book that kind of gives a really good summary and gets pretty in depth of describing the strategy and how to implement it.
Yeah, he came out with his book on the strategy back in 2002. And I came out with my book on the strategy, Master Your Mortgage for Financial Freedom. That came out in November of 2019. Okay. Number one in 22 categories on launch day on Amazon, Mackenzie.
Nice.
So this is my big bragging moment for the evening.
We're in the presence of celebrities here. Number one on book releases. I don't even have a book, so you're a whole ahead of me there. But
well, even if you did have a book, I don't know if I'd buy it, Mackenzie.
That's right. I wouldn't either. Trust me. I can talk, but writing's a whole different ballgame. Well, Rob, what you've done so nicely for us, I know I picked your brain when we were getting prepped for the show, is you've gracefully donated some copies to the community. So folks, what we're going to do for the show tonight is we'll give away a couple copies on the show, as well as I'll give away some copies to the community at large. Now, they're just not going to be a quick pick of the name off the people watching the list. I do, folks, want you to interact and ask questions, because those questions will generate the right kind of conversation to help us all learn the strategy better. But really, I thought this would have been a really good conversation and helpful for the community, in the sense that we're all homeowners. So we have, our primary residence, and Rob has this strategy, again, where we can put ourselves in a better position to have more tax deductible interest or revenue to better our tax returns. So it's very applicable to the community at large. So Rob, we do appreciate you donating some of those books. So folks, we'll be watching the communication channel here. I know we've got Christine, you tuned in and said hi right before 7, which I always appreciate, by the way. So let's paint the picture. Rob, where do you want to take us when you first meet someone to explain this, and what are the key facts of it?
Yeah, well, I think if it's okay with you, I'll just share my screen here and go through the presentation.
Okay. While you're bringing that up, the reason we've got Shaune on the show as well is Shaune is one of the few Smith Manoeuvre certified mortgage brokers, probably in Canada, if I'm correct on that assumption. I'm looking at
sure
you, Shaune.
Rob can answer the question.
Yeah. I'm just trying to figure out the share screen here. I think I got it. But yeah, I'm going to talk about the Smith Manoeuvre Certified Professional Accreditation Program at the end of this presentation. But we've got 54 Smith Manoeuvre Certified Professionals across Canada to help Canadians implement this. And Shaune is one of the early adopters here. Okay. So he's been with us for a while. Okay. So for some reason,
well, we'll let Rob figure that out. So Shaune, if people are curious right now, and as they go through this process, they want to figure out what they need to get set up, How do you help from a mortgage broker perspective?
Well, we look at their situation with their property. One thing about the Smith Manoeuvre is you have to have 80% loan to value or better on your property. So more than 20% equity in your property to start doing it. So I don't want to steal all Rob's thunder here either, but I look at people's situation and how it can, if they got the right, they may have the right mortgage already. You know, there's all kinds of products out there that will work with this. So most of the big banks have a product. Manulife has a product.
Right.
MCAP has a product. So we review their portfolio, similar to what we did with your portfolio, and come up with what will work.
Okay, so I think I figured it out. Can we see that, Mackenzie?
Yep. You've got your slides right up on the screen here. So take it away.
Okay, well, let's dive into this. Turn your mortgage into an asset. Now, this is Alberta Landlord community, and using deductive reasoning, I established that you guys are all into investment real estate, but I want to forget about investment real estate for a moment. Okay, what we're going to do here is talk about how you can turn your principal residence mortgage into an asset. So this is of great importance for those of you who own a house and have a mortgage. And typically I start off with what are the issues that we Canadians are faced with? Well, we're faced with increased pension insecurity, job insecurity, taxes going nowhere but up, economic uncertainty. And what's holding us Canadians back as regards increasing our wealth? Well, we've got inflation, insufficient salary increases. We got high taxation. We pay more in tax than we do on food, clothing, and shelter combined. These are the three basic necessities of simple survival. We pay a lot of tax in Canada. And mortgages, even at low rates, are expensive. If I got a $450,000 mortgage these days, I have to earn over $1 million to pay that back, because I got to pay back the 450 grand. I also have to pay the interest on that, but I got to make these payments with after-tax dollars. So mortgages are very expensive. And then we got just the cost of life in general, right? It's very expensive to live in Canada. Now, most Canadians, we've got this sequential approach to our financial affairs. We've got these two big financial goals. One is to pay off our mortgage. We want to get rid of it. It's big and it's expensive, and that makes sense. But two, we also want to start saving for our retirement. We don't want to have to work for the rest of our lives. So we have to figure out which one of these two goals to attack first. But this decision is typically made for us, not by us, because if we don't take our dollars and contribute to our investment portfolio to prepare for our retirement, nobody cares, right? But if we don't make our mortgage payment, someone certainly does care. So it's made for us. So we focus on paying off this mortgage, typically at the expense of not getting invested for our future. So we're missing out on all this compound growth potential. And we're building up all this equity in our home that's doing nothing for us. And this can lead to some bad places. Right? I'm sure everybody knows someone who lives in a house with $600,000, $800,000, $900,000 equity, is completely paid off, but they're living on a fixed income in their retirement, right? They got to watch what they spend. Maybe they end up being financially reliant on their children, living in their basement suite or something, or downsizing when they don't want to. They're being forced to downsize their home because they can't afford it, or they sign up for a reverse mortgage. Now, I tend to do a lot of, I guess, bashing reverse mortgages. And I must say that we're happy that these products are available. I mean, not many institutions or people are going to be willing to lend money to unemployed senior citizens. So we're glad that the people who are in the position where they need a reverse mortgage can access one, but we want to be able definitely to avoid having to sign up for a reverse mortgage. We want options. What's another potentially bad place that we can end up in our retirement? So next time you're at a big box store, fast food restaurant, have a look around, and you'll see quite a few senior citizens working in these places. And for the vast majority of them, it's not because they want to be there, it's because they have to be there. Now, what's the typical advice that we hear from financial professionals when we're asking them, how do we increase our net worth? Well, they say invest more, max out your registered contributions, prepay your mortgage, reduce your debt. And the common thread in all of this advice is that all of these strategies require more money from you. But for many Canadians, there is little or no more money. You know, I know plenty of people who are making six-figure incomes and they're still having difficulty making ends meet. So what can we do if there is no more money? Well, we do have the ability to reduce our tax bill, increase the efficiency of debt repayment, and eliminate expensive debt sooner and invest found money. And there's only one strategy that can accomplish all of this with no new money from your pockets, and that is, of course, the Smith Maneuver. It is a mortgage conversion strategy. It's a debt conversion strategy. And there's 3 benefits that you start to see: reducing your tax bill, eliminating your mortgage in record time, and enjoying compound growth. These benefits happen now, they occur simultaneously, and they improve exponentially as well. And no new cash from the homeowner is required. The strategy uses cash that you're already outlaying. It maximizes the mortgage debt that you already have in place. And it's just a one-time restructuring of your existing financial affairs, and possibly not even that. You may be set up for this strategy and just not know it. Now, for real estate investment groups like yours, I don't typically have to spend a whole lot of time discussing debt here, but there's 2 types of debt. There's non-deductible debt, which is relatively expensive, and it's taken on to acquire depreciating assets. So if I'm paying 6% because I borrowed to buy a car, I'm actually paying 6%. That's the real cost. And I borrowed that money, that expensive debt, in order to buy an asset which is going to depreciate in value starting right away and eventually disappear. Vacations, cars, dinners, gas, groceries, etc. But tax-deductible debt is different. It's relatively inexpensive, and it is taken on to acquire appreciating assets. So if I borrow that money at the same 6%, but I'm at the 50% marginal tax rate, that money only costs me 3% in reality, not 6%, because it's tax deductible. And I had to, in order to get those deductions, buy an asset which has, in all likelihood, the possibility of increasing in value, right? Investing. Now, the wealthy understand the difference between these 2 types of debt very, very clearly. And this is one of the main reasons they are wealthy. They understand how to use debt to their advantage. And this is just yesterday, on the 10th, National Post. When I was an advisor to very high net worth clients who literally had millions to invest, they too also had debt. But it was used to increase their wealth, not to spend more on depreciating assets like cars, boats, and toys. Instead, they would use debt to leverage and purchase stock on investment properties, basically spending this debt on any appreciating asset, which would give them a higher rate of return, and in most cases, a tax write-off from the interest on the borrowed funds. Now, these 2 types of debt, one is expensive and you acquire depreciating assets, and the other is inexpensive and you're acquiring appreciating assets. The exception to this rule is your house. We can reasonably expect this house to appreciate in value over time, but the mortgage is not tax deductible. But we're going to solve this problem.
And so just to clarify again, so we got, if you go back that one slide there, Rob, non-deductible versus tax deductible. We're talking about debt in general. So car loans, HELOCs, whatever, those things are purchased like they're going to buy a vehicle, for example. It's just that's relatively expensive where you're getting at. And this play is taking some of this debt, depending on how we set it up, and put into a tax deductible state where we can apply it now on our tax return.
Yeah, that's right.
That's right. Right off out of it. Okay.
That's right. We've got the debt, our mortgage. It's not tax deductible. That's the problem we need to solve, and that's what we do with the Smith Manoeuvres. We convert that non-deductible debt to tax-deductible debt, and in the meanwhile, we're acquiring assets which are going to increase in value over time.
All right, let's keep on going. Love it.
So, but we got to take action, right? Now, your mortgage is one of your biggest investment opportunities, but you have to invest your home equity now instead of consuming it later. So you got to put it to work now rather than let it molder at less than 0%. Growth due to inflation. But in order to do this, we need a readvanceable mortgage. And this is where Shaune Impey comes into play here. He's a Smith Manoeuvre certified professional mortgage broker. Now, here's a representation of a typical mortgage. You get a down payment together. You go to the bank, say, hey, bank, I found a house I want to buy. I need to borrow $500,000. So they lend it to you. And all of this debt is non-tax deductible. And you promise to the banker, your spouse, and your God that you're going to pay this off over the next 25 years. Well, a readvanceable mortgage, which is what is required, it still has that same component, that non-deductible debt there of $500,000, but it's also got this line of credit which is attached to it. Now, not all readvanceable mortgages look like this, but it's a pretty accurate representation here. They function differently, but the principle is that the lender is willing to always have you effectively owe them the same amount they lent you day one. So what happens is when you make a payment on your mortgage and that balance goes down on the line of credit side, because these two portions talk to each other, the line of credit limit will increase dollar for dollar, and they'll let you get back at it. Now, most Canadians who have this type of mortgage, maybe some of them didn't even know that why they got put into this. They don't recognize it's a readvanceable. They don't know what's going on here, but they see that, you know, each month they get their statement, they've made a mortgage payment, and wow, my line of credit limit has increased. I could pull $1,000 out and make a payment on a Mercedes. Fantastic. I can go on vacation, right? I can buy toys and boats and all this stuff. So all they're doing in this case is paying down fully non-tax deductible debt over here and replacing it with fully non-tax deductible debt over here. So their total debt isn't changing, but they're buying assets which depreciate in value. This is wealth destruction.
Okay. And so just for clarity, because I know we're using a lot of terms here, what is readvanceable mortgage in plain language? Maybe Shaune, you can answer that.
But I described the Smith Manoeuvre as refinancing your house every month.
Okay. So you're getting this HELOC line of credit, but it's based on the collateral, the value of your house. And every month, as that mortgage payment is a mix of both interest and principal, the principal portion of your mortgage payment, let's say if it's $1,200 and you're in the middle, $600 goes towards interest, $600 goes towards paying off the loan on your house. That $600 now becomes borrowable money in the form of a line of credit, and that's what we're adding to every month. That we can now take that money, incur this interest, and have that interest written off if you're using the right asset, and I'll let you get into that. But that's kind of, am I describing that right?
Yeah, and I've got a slide which effectively goes through that.
Okay.
Well, you're exactly on the right track here.
Okay.
So how the Smith Manoeuvre works is on a monthly basis, we're making that regular mortgage payment. Whether we're doing the Smith Manoeuvre or not, if we've got a mortgage, we make a regular monthly mortgage payment. That doesn't change. But when that payment it gets applied against that balance, and the line of credit limit subsequently increases however much that non-deductible debt went down, we're going to pull that out and get it invested. So we're going to do that on a monthly basis. We're going to make a payment, we're going to reborrow. We're going to make a payment, reborrow. And on an annual basis, because we have borrowed to invest with a reasonable expectation of generating income on a monthly basis, we get a tax refund at the end of the year, because the government takes their pound of flesh off our paycheck every 2 weeks. And by the time we send our return in, they look at it and say, oh, we took too much off your paycheck every 2 weeks for the past year. Here's money back. This is money that otherwise we would not have received. We're receiving it only because we implemented the Smith Manoeuvre. So we take that money and we make a prepayment against our mortgage. This is found money, free from the government. We prepay our mortgage, and then that amount that we prepay it by on an annual basis is available to invest as well.
Okay. So I'm going to just slow you down so we can keep up. So we're taking this, let me just think this through. We are moving money around. We've created a greater tax write-off that we're applying to our tax return, and therefore our tax return, we're getting in theory, we're getting this refund that's typically larger than we would if we had not done this move. And then you're saying take that money that we've now created without no additional cost, and then throw that onto a prepayment to speed up the down payment of the principal mortgage.
Yeah, because we're borrowing to invest on a monthly basis, we're generating tax deductions. These lead to the refund, because these are deductions that otherwise we wouldn't have had. So we get this refund, we prepay our mortgage, and the more you prepay something, the faster it goes away. This is why this strategy is so effective in getting rid of that non-deductible mortgage debt much quicker than otherwise possible. Okay,
cool.
So again, if you borrow to invest with the reasonable expectation of generating income, you can deduct the interest on that borrowing. The rules are slightly different for Quebec, but it generally applies across the country. Yeah. So here's what we were talking about. You know, what you were asking about, Mackenzie, is let's say we got a $2,200 mortgage payment. Well, some of that, $1,260 in this case, goes to interest, and that's gone. We don't ever see that $1,260 again. But some of it reduces principal. So that $500,000 mortgage goes down to $499,060. So down, that balance goes by $940. The limit opens up on this line of credit by $940, and we can pull that out and we can invest it, right? But we need to borrow with the reasonable expectation of generating income. And so that's what we do on a monthly basis. We pay it down, we borrow it back to invest. We pay it down, out it goes to invest until we have converted that full $500,000 of formerly non-deductible debt to fully tax-deductible debt. And when we do that, when we created this 100% tax-deductible debt, we're able to generate these refunds, which allow us to get rid of that mortgage faster. And plus, because we're investing on a monthly basis starting now, we're taking advantage of compound growth, right? We're investing now, which means we're letting this money grow for as long as it possibly can. So the Smith Manoeuvre converts your 100% non-deductible mortgage to 100% tax-deductible debt. Each month you generate valuable and increasing tax deductions. You're able to eliminate your mortgage in record time, and you're able to invest money you wouldn't otherwise have available. And it happens now, happens simultaneously, and needs no new extra cash from you. And this is where a lot of people who are paying attention will chime up and say, hold on a sec, hold on. This Smith guy says no new money is required from me. But before I started doing the Smith Manoeuvre, I had a mortgage payment. After I contacted Shaune Impey and he put me in the right mortgage and I started doing the Smith Manoeuvre, I still had a mortgage payment, but now I also have a line of credit balance, which is increasing each month. And that has to get paid each month. And if it's not coming from my pocket, where the heck is it coming from? What's the Smith guy talking about? Well, the answer will astound and amaze you folks. And it lies in the increasing efficiency of the regular mortgage payment. So this example is based on a $400,000 mortgage. The very first month I make my mortgage payment, in this case, $2,214, the amount of that payment that goes to interest is $1,486. The amount that reduces principal is $728. And therefore, when that balance goes down by $728, the line of credit limit increases by $728, and I pull it out and I get it invested. The next month, I still make a $2,214 payment. That hasn't changed, but a little bit less goes against principal. A little bit less goes against interest and a little bit more goes against principal, $730. So I can pull that $730 out. $2 then gets taken by the lender out of this Smith Manoeuvre checking account that I've set up. That $730 resides there now. $2 comes out to service the first month's borrowing, leaving $728 to invest. The third month, same payment, even less to interest, more to principal, more can be reborrowed. $5 to interest to pay for the first 2 months reborrowing, still leaves $728 to invest. So on and on this goes. I'm able to reborrow a little bit more each and every month, which takes care of that slightly increasing interest expense on a monthly basis, which leaves more or less a constant amount that I can invest. And so none of this has come from my pocket. The only amount I'm coming out of pocket in this case is $2,214, which I was whether I'm doing the Smith Manoeuvre or not.
Okay.
So what's it worth? Well, we're finding for the typical Canadian homeowner current situation, the plain Jane Smith Manoeuvre, which is what we just looked at, is worth around several $100,000. And that, again, the plain Jane Smith Manoeuvre is just using your regular mortgage payment. But we've got a number of accelerators that may be available to us. The cash flow diversion, the debt swap, the drip, the prime, the pump, and the cash flow down. Now, when we're looking at the cash flow diversion accelerator, some people may be in the fortunate position where they're able to, once their income gets deposited into their personal checking account, they tell an investment company, let's call it a mutual fund company. They say, come in each month to this account, take $400. I don't even want to see it. I want you to come in and take it and get it invested for me. Well, that's great. They're able to do, a little bit of investing, and a lot of people aren't. So they're in a fortunate position here, but there's a better way to structure this. Instead, after that income comes into their personal checking account, they can instruct a prepayment against their mortgage. And then when this goes down by $400, this increases by $400. So they can pull this out to invest. So they're still getting that $400 invested. That hasn't changed the amount out of pocket. They were investing $400 before, they're investing $400 now, but they're making it work for them. And this is above and beyond the regular mortgage payment, right? That was happening up here in a previous slide, that regular mortgage payment reducing principal. So this is $400 in addition. And this prepayment of $400 each and every month does wonders in accelerating how fast you get rid of that non-deductible debt. The debt swap. Because I've been investing $400 a month for quite a while now, I've got $10,000 worth of mutual funds built up. Well, what I can do is say, I want to sell my investments. I want to get $10,000 in cash. I'm going to take that cash. I'm going to prepay my mortgage by that 10 grand. So $500,000 balance goes down to 490. Boom. And then that line of credit limit increases by that same 10,000, and I pull it out, and then I buy the exact same investment that I just sold 7 to 10 days earlier. Right? Now we want to look at taxation. We want to look at superficial loss rules on the repurchase. And so we can buy the same investment. We can buy a different one. Maybe this one hasn't been performing lately. We want to buy something else. But I get the cash, I prepay, I reborrow, and then invest again. And I've immediately converted $10,000 of bad debt to $10,000 of good debt. And I can do this with cash as well. I got $10,000 cash. That's my emergency fund. Well, you know what I'm going to do? I'm going to go get an unsecured line of credit. I'm going to swear up and down that I'm not going to pull any money from that line of credit unless it's an emergency, in which case I can now take that cash, which used to be my emergency fund, and prepay my mortgage and then reborrow it and invest it. Again, another 10 grand down against that mortgage balance.
So I'm keeping up with you as much as I can. So if I understand the strategy correctly, the key thing here is you're either taking cash or you're taking an investment, you're selling it, and then instead of taking the proceeds of that sale of that investment and reinvesting it again, you're pushing it back through the mortgage. I don't call it washing the money, but then bring it back into the HELOC and pulling that out where it becomes. Is that the key difference here? Is the cycle of money has to flow through the mortgage and the HELOC before you to do this debt swap accelerator?
Well, the whole goal of this strategy, the Smith Maneuver, is to convert your non-deductible debt to tax-deductible debt, because as you do that, you acquire assets which are going to appreciate over time. Okay. But the faster you can pay down this non-deductible debt and replace it with tax-deductible debt, the better off you're going to be. So if I've got $10,000 in paid up investments somewhere, I can sell them for cash. Boom. I've just paid off 10 grand of non-deductible debt. That's huge. I've reborrowed it to buy the investment again. So it's replacing, swapping bad debt.
You've got that interest, then you have that interest available to write off. Okay.
Yeah, because the interest on that $10,000 that I borrowed here is tax deductible.
Yes. Okay.
Right? Because I borrowed to invest. Yeah.
All right, we got some questions here. Maybe we'll kind of take a break, or how do you want to tackle the questions as they come up, or should we kind of pin some of the end there, Rob? What's easier for you?
I might get to some of the answers as we go through this. Let's just power through, and then we can go through all the questions at the end.
Okay, sure. Let's do that.
Yeah. Okay. Thanks. So the drip accelerator, this $10,000 of investments that we were just looking at, maybe they send, monthly or semi-annually or annually. Maybe they have dividends. A lot of Canadians say, I don't want those dividends in cash. I want you to reinvest them automatically, right? I'm in this for growth. Buy me more units with that dividend. Well, instead, we can say, hey, I do want that cash, because when I receive that dividend in cash, I can then prepay my mortgage by it. I can reborrow and then buy the exact same stock or mutual fund that was sent out that dividend in the first place. So I'm making this $300 dividend work twice. Pay down and convert debt faster and get invested for growth. Some people might ask about taxation, having it automatically reinvest or take it in cash, and there's no change in taxation. You're taxed the year in which you're awarded that dividend, whether you reinvest it or take the cash.
Okay.
So prime the pump. Here's where we're going to start bringing it back to investment real estate. This is an example of, I talked to Shaune because I want to get in the right type of mortgage. And my mortgage balance is currently $500,000, and the house appraises at $625,000. Well, a readvanceable lender will only go up to 80% loan to value. So they'll say, "Yep, we'll give you $500,000 total loan based on a $625,000 house," and all of that they're willing to lend us has to go to pay out the mortgage that doesn't work for the strategy. So that means that at the very beginning of my strategy, there is no immediately available credit. There's no
that sounds like me.
Right. So at this point, I would start, with the plain Jane Smith Maneuver with just my regular mortgage payment, pay it down each month, borrow it back. Or maybe I have a cash flow diversion available to me, but I don't have the prime the pump available to me. What happens though if my house appraises at $850,000? Well, at 80% loan to value, they're willing to lend me a total of $680,000, but I only need $500,000 to pay out my non-functioning mortgage. So I borrow $500 from the new lender. That goes to pay out the old lender. Now this is a bit, busy here because of the 65% HELOC rule. But the way the numbers play out, the readvanceable lender is saying, okay, you've borrowed $500 to pay out the old mortgage, but we're going to give you a line of credit with an immediately available limit of $52,500.
The difference on the new appraised value up to 80% or 65.
65, yeah.
Okay, sure.
So So I can do whatever I want with this. Technically, I can pull this 52,500. I can go buy a car. I can go on vacation. I can pull it and take the cash and throw it in the fireplace and burn it. The lender does not care. They've got the house as security.
Yes.
But what I do with this, if I do anything at all, I don't have to do anything with this 52.5. I can leave it there. I can pull half of it. I can pull all of it. But what I'm going to do is invest it. Am I going to invest in securities like mutual funds and stocks? Am I going to start a new business? Go into private lending? Am I going to buy a new piece of investment real estate? So this, when you're refinancing into a mortgage, which is going to work for the strategy that we just looked at, there may be an opportunity for you to buy, if you don't have investment real estate already, your first piece. Or if you do, your second property. If you're refinancing to do the Smith Manoeuvre in any event, now you're going to have access to some equity if depending, how your numbers flesh out.
Yeah.
So if we look at the next accelerator, the cash flow dam, this is where, because I pulled that money out, I primed the pump with the available credit. I bought a rental property. I installed a renter, and he's paying me $3,000 a month. That's great. Now, what happens traditionally with many Canadians, they take the $3,000 in rental receipts into their bank account, and they turn right around and they make the expense payments on that rental property, the mortgage, the maintenance, etc., utilities. So money in, money out. Now, this is a revenue neutral, cash flow neutral example, but money in, money out. Well, they're missing out on a very, very valuable opportunity, because instead, as I've assuming you've guessed by now, Mackenzie, what they can do is after that $3,000 comes in from their renter, they can make a prepayment against their own mortgage. This is the house in which they live, this non-deductible mortgage debt. So that prepayment of $3,000 reduces the balance by $3,000. The line of credit limit increases by $3,000. And they pull it out back into their bank account, and then they make the mortgage payment on their rental property and the other proprietorship expenses. So instead of money in, money out, it's money in, run it through the mortgage, bring it out, and then go to service the expenses. And Shaune will tell you, if you're prepaying your mortgage by $3,000 a month, that 25-year amortized mortgage is going to be gone in 10, 9, 8, 7 years. It's gone very, very quickly. It's hugely powerful.
So and I'm slowly at the game here, catching up to you number wizards here. But the whole play is initially all us landlords. So a lot of us, myself included, I've got separate bank accounts. I've got rent comes in. Oh man, whatever. And I'm cash flowing, whatever I'm cash flowing. I've got that money in, that money out, pay my bills is the standard example. But now you're pushing that money on prepayment into the mortgage, and then it's getting pushed right over into the HELOC side, because obviously we're increasing our balance. And then you're taking that money out again, continuing on how I would initially pay my typical rental property bills, insurance, property tax, mortgage, all that kind of stuff. But I've just created more tax write-off interest on that HELOC is what I've done.
That's right. Because if I don't do this, that $3,000 of debt it remains non-deductible. It's expensive. But if I do the cash flow down, that $3,000 of debt now resides over here on the tax deductible side. Mm-hmm. Right? And it's tax deductible because, as we know, if we borrow to invest with a reasonable expectation of generating income, we can deduct the interest. And here I'm borrowing to invest in my business, this proprietorship. This business can be expected to generate revenue because it's rental property.
Yes. So a question to you. I'm probably jumping the gun there. So just tell me if we're going to answer this question later. We're all folks that own multiple properties. You can already write off the interest on an investment property. Mm-hmm. So is there really any value to do this on a rental property? Is this more or less just for the primary residence where it's not taxed on? This
is a very good question. It's critical to remember, everybody, that what we're doing here is we're converting non-deductible debt to deductible debt. And that entails converting the debt on our principal residence. Yeah. So the debt for your rental property, the rental property mortgage, that's already tax deductible. Yeah. So you don't implement the Smith Manoeuvre on a rental property because it's a debt conversion strategy and there's no debt to convert. It's already deductible. But your rental properties have the ability to greatly speed up the conversion of your principal residence mortgage.
In this prime example right here, this cash flow dam additional strategy. Gotcha. Okay.
Yeah. So your rental properties can be a tool. This accelerator, it's a tool to help you speed up the conversion process of your principal residence.
Let me throw a caveat in there. So
keep us honest, Shaune.
Yeah. So as someone who owns rental properties, number one, you want to keep your cash flow as high as possible. So, I encourage people to set up 30-year amortizations, etc. Do monthly payments. Don't accelerate on your rental property because you want a cash flow. And you're right, your interest is already deductible, but you still have to make that regular payment of $1,500 or something on your rental property. So there's interest and principal. So if you set up a Smith Manoeuvre style mortgage on your rental property, you have access to that principal every month. So let's say it's $500 comes back into your principal. So you have that HELOC available. Now you don't want to accelerate it like Robinson says, because your interest on your mortgage on your rental might be, these days it might be like 2.5%. Your HELOC might be 3.5%. So accelerating your mortgage pay down on a rental to turn 2.5% debt that's deductible into 3.5% debt, deductible debt, doesn't make any sense.
That kind of sucks.
What does make sense is now you got this HELOC, so it becomes your emergency fund for your rental, your staying power fund, or whatever names that people give it. So after a year of your rental, you might have $5,000 or $6,000 available in a HELOC. You may not even want to touch it, but it
sleep at night.
It means you don't have to have money in your rental property account to cover off the furnace or the hot water tank, everything else. So
Yeah,
you can access this HELOC and its tax deductible purposes. So
yeah, and that's a really good point, Shaune. In that, we got a readvanceable mortgage on our principal residence, and we're prepaying this as aggressively as we can because we want to get rid of this non-deductible debt. Well, on our rental property, on this proprietorship, also get a readvanceable, like Shaune was talking about. Get a readvanceable there, but don't prepay it. It doesn't make sense to prepay tax deductible debt and get rid of it as fast as you can. Just pay the minimum. But because it's a readvanceable mortgage that Shaune gets you for your rental property, again, like he said earlier, it's like you're financing that rental property each and every month. And if you don't want to access the increasing available credit in that rental property, then don't. But if you do, you can pull that out and invest it elsewhere, right? Or leave it for rental expenses that pop up.
The only reason you'd want to pull off a HELOC sitting on an investment property where it's already 100% tax deductible and interest is if you could beat the interest rate on your HELOC. And if you're willing to take that risk, that would probably be the only time I would look at doing that. But
well, yeah, I mean, it's not difficult. When I was an advisor for 12 years and I was getting, consistently 10% for my investors. And now, especially, what does that HELOC cost you? And throw in the fact that if you're pulling from it to invest, from your rental HELOC even to invest, the real rate is lower because it's tax deductible. So it's not difficult at all to beat that spread.
Yeah, if you've got 3 or 4 rentals building up $800 to $1,000 a month in principal, $3,000-$4,000 a month, it doesn't take long till you have enough built up in your HELOCs that you may be able to use some of it for investment in another rental property from equity that you wouldn't have. So
interesting. Okay.
And Shaune's exactly right, because the last thing you want to do is if you got 3 properties, let's say, is, I want to buy my 4th. I got enough equity in my rental properties all combined to buy another property. Well, then you got to go requalify. You got to get them all appraised. You got to go. If you get a readvanceable right off the bat, you don't have to do that. The money's just sitting there waiting for you to pull it.
It's now a HELOC that with a property as collateral, so you pull the money without any talking.
The requalification is a good point. The other thing that might happen is properties sometimes go down in value. So if you have a $500,000 property with a $400,000 limit on your readvanceable mortgage HELOC, if you've been paying that down for a year and let's say the properties happen to drop $20,000 and you've paid $20,000 down in your HELOC, then you can still access that money and use it because the bank's not going to go check what the property is worth. If you didn't set up that readvanceable after a year and you said, hey, I paid $500, I want to go take my $20,000 out and requalify, and surprise, your property's only worth $480 and they're not going to give you that money.
Yeah.
So,
That's why it's so important to work with someone like Shaune, who understands real estate investing and knows the strategies, because it's not as, there's a lot of things that can be accomplished and done and strategized to really make your investment portfolio sing.
Cool. I'm going to read some of the comments because I know we're moving forward. I just want to, if they're relevant, let's take a stab in. If not, because it might be challenging if they're out of context to come back to some of these questions. So I'm going to hit up some here quickly. Sorry, folks, if you're on Facebook, you haven't given permission to StreamYard. I can't see your name, so I'm going to refer to you as Facebook user unless you ping me your name here. But we've got so someone says, I'd love to see an example at the end of the year how much interest you can write off and is it tax at a different way. So I believe you're going to answer this, Rob, because I think you've got a calculator that kind of shows this visually as we put the numbers. Okay, fantastic. We'll move on. If you do this on your own with an online banking, how does it work at your end? Do you get a separate slip from the bank? So that's a little bit more restructuring it from a tax perspective and an accounting perspective. Maybe we can touch on that high level.
Well, firstly, I will never, ever suggest anybody do any of this on their own.
Okay, good.
I'm fairly strict about this. We go to the dentist to get our teeth pulled. We go to the doctor to get our appendix out. And then we think, we can do our own investing when we're not investment specialists, and we think we can do our own taxes. And I know some people can, but yes, we're adding in some complexity here with this. And so this is when you really want to use a professional, a Smith Manoeuvre certified professional mortgage broker. Don't go to your banker and ask if you can have their Readvanceable. Talk to a guy like Shaune. Use a Smith Manoeuvre certified professional accountant. They know all this stuff. Investment advisor, etc. When you're doing this on your own, how do I do the reporting at tax time? How do I track? No one can give you advice. You're doing it on your own, right? You don't have professionals in your corner. So you are on your own, and you're opening yourself up to the CRA, which is the last thing anybody wants to do.
Yeah, the nuances are key here. So while you may look like you're doing it right in the surface, you put or move one transaction or do one thing wrong, then you've got a tax hit and the capital gains or something.
Or they disallow the deductions you've worked so hard to generate, but you haven't tracked it correctly, and you thought you were, whatever the case may be.
Perfect. Okay. Bill asks here, could you just take the $10,000 cash and invest it directly, still become tax deductible, correct? I don't know the context on that, so that might be a tough one to answer.
Well, or $10,000. The only thing that generates tax deductions is if you borrowed money, right? So if you've got cash and you invest it directly, you're not borrowing, therefore there's no tax deductions.
Makes a lot of sense. And that's the whole play here. This whole play is primary residence. You've got an existing debt that you can't do anything with right now. The interest, you can't do anything because it doesn't qualify in the eyes of CRA. We're now moving all this money and prepayments, getting the HELOC built up, pulling that money back out, putting it towards a tax deductible investment. So that tax vehicle, again, like you said, it can't be a boat, can't be a chip, can't be a car, but it's got to be mutual funds. It's got something that you're expecting a reasonable return on.
Yeah.
And then that whole movement has created a bunch of interest on that HELOC, and that is what you write off to get a bigger tax return at the end of the year. And now you're just repeating the cycle and speeding up faster and faster.
Yeah, that's right.
Oh, love it. Okay, continue on. All right. Okay, cool.
Okay.
Let's keep it going here. You're doing awesome.
So, quick summary. Each month you're investing money you wouldn't otherwise have available. You're generating these tax deductions, which increase, and you're eliminating your expense mortgage in record time. The benefits start now, occur simultaneously, and again, no new cash from use required. Now, when I hit play on this little video, Mackenzie, you let me know if you cannot hear my voice in the voiceover, because it's embedded in the video, okay?
Okay, we tested this earlier. It should work for you folks, but if you can't hear anything, ping right away. I'll let you know too,
Okay.
Rob. I'm going to mute myself.
Okay. Be a very, very fast demonstration of Smithman Calculator. So once in, I'm going to give it a name, this scenario, and we're going to head to the calculator. We can enter various types of income. I'm going to throw in $150,000 of employment income. I've also got a rental property proprietorship, and it generates $36,000 in rental revenues per year. And It cost me $34,000 a year to service the expenses on that rental property. I'm also going to input that I have $30,000 of mutual funds invested. And I've also got a $10,000 emergency fund. And down here we can see my marginal tax rate is 45.8%. I'm going to go to the next sheet. I'm going to fill in my house value at $750,000. The mortgage balance on that is currently $450,000. The interest rate is 2.9%. The amortization defaults to 25 years. On the readvanceable line of credit side of things, I've got a prime rate of 2.45 and a premium of 0.5% for a total of 2.95%. Next, I'm going to go to the fund page where we start to see results. I can throw in whatever I project my investment to grow at on an annual basis. We'll leave it at 8%. This is saying the very first month's mortgage payment leaves me $769 to invest. I'm going to go ahead and invest that all. Here's where we start to see some results. Taxation improvement, total deductions over the amortization of the mortgage of $109,000, which lead to total in tax refunds of $50,000. No amortization improvement yet, we'll see that soon, but a net worth improvement of $388,000 already at this point. Now here I can adjust the amount that I accept from the lender. They're willing to lend a total of $600, but I can move that up or down and we can see the results change. I won't go into an explanation on this right now, but let's just say I only want to accept $550,000 from the lender. So we've seen a bit of improvement in the results. Here's where we'll see amortization improvement. If I apply my annual tax refunds as a monthly prepayment against that an annual prepayment against that mortgage, and also reborrow that to invest, we'll see amortization improvement and also net worth improvement here. 2.33 years saved off my non-deductible mortgage, net worth improvement up to $551. The debt swap accelerator, I've got $30,000 that I already inputted in mutual funds. I'm going to go ahead and debt swap that and watch the results here. Years saved and net worth improvement. There we go, 4.6 years saved, net worth improvement of $791,000. I'm not going to input any future lump sums. What I'm going to do is debt swap my emergency cash. I'm going to secure a line of credit, a personal line of credit that I'm only going to use for emergencies. Therefore, I can debt swap this cash. I can prepay my mortgage and then get it invested. We're going to see further results here. Cash flow diversion. Let's say I have been investing $300 on a monthly basis. That's how I built up my $30,000 in mutual funds. So I'm going to go instead, apply that as a prepayment each month, and then reborrow it to invest. 5.42 and 869 goes to 8.42, and net worth improvement of $1.164 million. Cash flow dam accelerator. I previously entered my rental revenues and expenses, and that works out to $3,000 a month in revenues and expenses of $2,833. If I implement the cash flow dam accelerator, we're really going to want to watch this one here. Instead of saving 8.42 years off that mortgage at this point, I'm saving 18.25 years, which means my original 25-year amortized mortgage is going to be gone in 6.75 years. Dividend reinvestment plan accelerator, I won't go there at this moment. Prime the pump accelerator. Based on the numbers inputted, apart from that non-deductible mortgage debt when I refinance into a readvanceable mortgage, I've also got $100,000 of immediately available funds with which I can prime the pump. So I can withdraw some, all, or none of this if I wish. But if I do, I'm going to get this invested immediately. So if I pull $50,000 of this to prime the pump, then we'll watch the net worth improvement go from 1.3 to 1.7. Now I've saved 18.5 years off my mortgage. I've received total tax refunds over the course of the mortgage of $145,000. And again, instead of 25 years, that mortgage has gone 6.5 years. So this net worth improvement, this is net worth improvement, meaning I've got an investment portfolio of $2.21 million offset by 100% a tax-deductible investment loan of $484,000, leaves a net improvement $1.726 million. And the next screen here, that just shows the graph. The green line descending at 25 years to the x-axis is a 25-year amortization. This blue line hitting $0 is the reduced amortization of the mortgage. The red line over here is my investment portfolio. The yellow line is my total debt. And then I can view and print a report. I'm just going to summarize the results. It's also going to give me my instructions for the monthly process of the Smith Manoeuvre based on my numbers. So there you go, a quick demonstration of the Smithman Calculator. I hope you enjoyed. Okay, so just really quick, we talked about this, you and I, Mackenzie, before the start here, but my dad, Fraser, developed a strategy when he was a financial planner back in the mid-'80s. And he retired in 2000 to write his book, which came out in 2002. Then he came back into planning in 2005 until he passed away in 2011. I joined him in 06. When he passed away, I took on his clients and was an investment advisor until the middle of 2018 when I sold my practice, because I wanted to get word out to Canadian homeowners coast to coast. It's not easy out there. There's a lot of Canadians who need help, who are looking for help. And so that's what I did. Sold my practice to stop educating Canadians one at a time across a desk and really stand up and, with my megaphone and do these interviews like I'm doing tonight, that sort of thing. So I came out with my book, Master Your Mortgage for Financial Freedom, in 2019. And in 2020, I started the Smith Manoeuvre Certified Professional Accreditation Program. And what that entails is, we're training financial professionals all across the country: realtors, mortgage brokers, investment advisors, conveyancers, insurance brokers, accountants, in the strategy, so that Canadians across the country will have professionals local to them who can help them implement the strategy, and surround themselves with these financial professionals who are not only great at their industry, but also fully conversant in the Smith Manoeuvre strategy. Now, if you're looking to implement the Smith Manoeuvre, normally I would be telling people to go to smithman.net. You can click on Find or Become a Smith Manoeuvre Certified Professional. But we've got an SMCP on the call here, Shaune Impey. That's your first stop. So you're going to want to make sure, Mackenzie, that if everybody doesn't know Shaune already, they have a way to contact him if they want to pursue this, learn a little bit more about it. But I would suggest, you do your homework in advance. Learn a bit more about the strategy. On our website, smithman.net, we've got the book. We've got the Smithman Calculator. We've got the homeowners course. Now, start with the book. And if you don't want to buy it from me, go to the library and check it out. That won't cost you anything. But do look into the strategy. Obviously, I can't in an hour cover everything, but the book is a good place to start.
Yeah.
And lastly, procrastination is the enemy of your financial success. That's a quote from my old man, Fraser.
Ain't that true? That's fantastic. That is a lot of information. I think probably for us to wrap our head around it, because you have the primary strategy, which is all things focused around this primary residence where we got no tax deductible interest because it's non-tax deductible. How can we move more of these streams of money, which are all those different sub strategies? Perfect. Back into that primary residence, do a rapid pay down, and then we're ballooning or growing this massive HELOC, which then we take those monies and maybe repurpose them however we choose to. And again, we can get more detail, but that is cool. I heard this once before. I did catch you in one of the other shows. I couldn't wrap my head around the part when we started talking about the rental properties, because I knew it was already tax deductible, but we're not actually touching that, except for if there's cash flow left over, because that money's not doing anything. So why not add it in there? So that makes a lot more sense.
Well, yeah, like in the example in the calculator, let's say I got $3,000 in rental revenues. I'm prepaying my mortgage by $3,000. I'm able to re-borrow that $3,000. But if my rental property only cost me $2,500 a month, then $2,500 goes to service the rental expenses. I've still got $500 I can invest. Where do I want to put it? Do I want to put it in mutual funds, stocks, or ETFs or something? Absolutely, right? And that's what grows your portfolio on the security side. So there's any number of things you can do, or you can let that build up as your emergency fund for your rental property. So there's any number of things that can be done. to understand the possibilities here, it's important to speak with someone like Shaune, who is not only a mortgage broker and get you set up on your principal residence, on your rental properties, but he can also show you other strategies on where you can move your money around and how you can use that to your benefit.
Okay. We're at 8 o'clock here. I would love if I can keep you for a little bit of overtime, maybe another 5 or 10 minutes. We can kind of answer a few questions more specifically if we can help some folks out. And then I think Rob will I'd like to probably have you back. Maybe we'll do more of an interactive session where we can kind of go through some scenarios just to help maybe paint a better picture and play with that calculator. Sure. I think that would give clarity of what you're saying, but I like it. I know maybe because I'm a landlord, I'm kind of into the numbers here. You've got me to wrap my head. It's I think the key takeaway is not so much like the ROI and all that stuff and the numbers. It's how you've moved money around to create opportunities on the tax deductible side. You've got those bigger tax returns, and now you're just compounding those effects by hammering everything on your principal mortgage. And it's
yeah. And as we saw, it's not there's no additional money that you're taking. Now the calculator says if you prime the pump, if you pull $50,000 of additional leverage after you refinance and go invest it somewhere, if that costs you $130 a month, then the calculator expects you to come out of pocket by $130 to prepay your mortgage, and then when it is made available, that $130 is then can service the interest on that $50,000 that you pulled out day one, because that's new borrowing. That's incremental leverage. And if you can't afford to come out of pocket to service that interest, then maybe you shouldn't be doing it. And that leaves the most amount that you can invest on a monthly basis through the strategy. That's the only instance where this is new money coming out of your pocket, and all of that we saw there. Now, this is a very good question. Can we go after this one, Mackenzie?
Absolutely. So, Mindy, I believe this is you if I'm reading through the comments well enough here. You can take the money from your HELOC on the rental and move it to your primary house HELOC, then reinvest.
You want the short answer?
I'm gonna guess no. If I've followed the path correctly, no, right?
Yeah, the answer is well, you can, but you're not doing yourself any favor. Yeah. The reason is we have to remember that just because the property is a rental property, that doesn't mean all borrowing against it is tax deductible. If I borrow from the bank to buy that business, that rental property, the interest on that mortgage is tax deductible. And if I have a HELOC or available equity secured by that rental property, just because I'm already deducting interest and that it's a rental property doesn't mean that when I borrow that next amount to put somewhere, it's automatically deductible. If I borrow to invest, yes, that is as well deductible. But if I borrow to consume, which is in this case what we're doing, I'm borrowing from my HELOC on my rental property. What did I do with that money? I paid my own mortgage down. That is non-deductible. That is not a deductible use of borrowed funds. So now I've got a rental property, and some of that mortgage debt is deductible because I borrowed to buy the property, and some of it is not tax deductible because I borrowed to pay my mortgage down. So again, this is why you need accountants and investment advisors on your side, because like I said earlier, there are things where you think you might be able to do something and it turns out you can't, or you might think you can't do something and it turns out you can.
Yeah, and that blows the whole thing out of the water for sure if there's a misstep. Okay, that is awesome. Do we have any accountant referrals that you've got in Western Canada? I know last I saw you in the show, you're expanding this in recent times. So
yeah, I just got another application for the program today. Unfortunately, we don't have any accountants in Edmonton just yet. I keep on hassling Shaune to go ask his accountant friends if they want to sign up, because all the people in Edmonton are using an SMCP accountant in Calgary at this time. And she's pretty busy because of all the referrals we're sending her. But if you want a referral for any other type of professional, you already know Shaune. You can go directly to him for the mortgages. But if you want some other type of professional, go to smithman.net. And there's you can click on find or become a Smith Manoeuvre certified professional. Follow that through, submit your inquiry, say you're looking for an accountant. Are you already working with an SMCP professional in any of the areas? Yes, Shaune MP Mortgage Broker. Right, just so I know.
Okay, no, that's fantastic. That's very cool. As mentioned, folks, we're giving away some books, so thank you very much for participating. I'm gonna give one to Christine. You're always on time, typically earlier than us, so you definitely got a book. And then Mindy as well, since you're asking some questions, that's great. And you know what? I'm going to do a bonus book. I know, Bill, that you're in there as well. So folks, you three guys you'll have books. I will get them in due time from Rob, because I actually never gave him my mailing address, so there'll be a little bit delay, but we'll get those mailed out to you guys. Awesome. Thanks for tuning in. Rob, that was awesome. That answered some gray areas I had. I actually started on the strategy. I don't really understand it, other than I liked it, because obviously from the numbers side, but now it makes a little bit more sense. Is primarily everything's about your primary residence, because it's non-tax deductible. Find all these different cash streams that aren't making you money right now. Move that in, build up that interest write-off, pull it back out on the HELOC side, put those monies back towards their original function. If it's going to be your paying down your expenses on your rental property or whatever, or if you've got other investments, it's not just tied to real estate, right? You're talking anything that's related to
anything. If you borrow to invest with a reasonable expectation of generating income, stocks, bonds, mutual funds, private lending, investment real estate. So for groups like yours who are investment real estate focused, it really is important to remember that we're talking about our principal residence here. What do I have in my life after Shaune sets me up with the right mortgage? What do I have going on in my life which can speed up the conversion of that non-deductible debt? Do I have investment real estate? Yes, great. I'm going to do the cash flow down. Do I have existing mutual funds or ETFs somewhere? Can I redeem for cash and do that accelerator? What do I have already going on? And do I want to commit a little bit more from my pocket? Because you certainly can. $200 cash. There's a field in the calculator. If you could squeeze more personal cash, throw that in. Sure, why not? Right?
Interesting. Yeah, one challenge I see for some of us that have built up a portfolio, so I'm just going to throw this out there, is if you've got a joint venture partner, so therefore you have a split on that cash flow, and part of how you, on your investment properties, if there's a joint venture partner that has a beneficial interest, pulling the full cash flow out might not be appropriate. But of course, if you own your own rental properties outright fully, and you've got the $300 to $500 each month coming on these properties, like you said, move that cash over. And then Shaune, you had a great point too about putting HELOCs, readvanceable HELOCs, to keep those sleep at night funds, as we call it, so we can still rest easy with our investments in case something goes wrong. All right, I gotta play with the calculator now, because now you got my gears going. So very cool. Gentlemen, that was a fantastic show. I'll get you guys both again one more time, share how people can get a hold of you if you want. Also, folks, I am putting an information page up for Rob on our Alberta Landlord Community.ca. It's our Money Network's private network. We'll have a whole information section. I'll link everything that Rob's given me, a bunch of collateral and marketing material. I'm going to put that all in there for you folks as well if you want to do a little more research. And of course, check out his website.
Yeah, smithman.net. That's right.
Yeah,
so
smithman.net.
Just Google my name. It's not very common. So if you put Shaune MP Mortgage Broker or just Shaune MP, you'll find me on my Facebook page or ShauneMP.com. Get all my contact information. So I don't know if my name displayed on where people can see there. I don't see it there. So.
I got a comment. Let me do that here for you. There you go, Shaune MP. You're back.
Shaune, I actually Googled world's greatest mortgage broker and your name came up top of the list. So maybe that's a bit easier.
I love it. Yeah. Anyways, folks, thanks for tuning in. This isn't our typical landlord tenant discussion shows. We usually tackle the ongoing day-to-day problems, but I heard about this at the grapevine through some other investing groups I'm a part of, and I just thought, you know what, we're all owners in this page for sure. Obviously, some with multiple titles underneath our name. Why not have such an applicable strategy to hammer down some principal debt and on your residence? So I think it's a very cool strategy. Gentlemen, thanks so much for tuning with us tonight. We really appreciate it.
Thank you.
Thanks, everybody.
Perfect. We'll wrap it up. And folks, Bill and Christine and Mindy, send me a message on Facebook. I'll get a hold of your addresses and I'll arrange the shipping of those books for you. Okay, we'll talk soon, and we'll see you guys next Wednesday at 7 o'clock. Thank you very much.